The markets are screaming about geopolitical fear, and the evidence is right there in a fundamental asset performance paradox.
Precisely. If you're a global decision maker, your portfolio is telling you that the entire peace dividend era is officially dead.
Yeah.
And the shift is purely toward, tangible protection.
Okay, let's unpack this for you. On one side, physical gold has just spiked vertically. It's pushing well past its all-time high and consistently trading above $4,400 an ounce.
Historic move.
It is. It signals extreme, almost existential global risk. And then, conversely, the asset once championed as digital gold, Bitcoin.
Right.
Well, it's having a terrible year.
Right.
It's showing negative returns, down 6% year to date, and it's trading exactly like a highly volatile tech stock.
And what's fascinating here is the absolute decoupling. That price divergence signals that institutional capital isn't really prioritizing censorship resistance anymore. They're prioritizing non-sovereign, tangible assets of last resort. They are fully pricing in the anticipation of global conflict and high structural inflation.
So gold is the final backstop.
Gold is the asset of last resort. Bitcoin, post-ETF, has been, let's say, re-rated as a highly leveraged, risk-on tech trade.
This is Neural Pulse. Let's analyze. We'll begin with the most kinetic flashpoints, and we'll start in the Western Hemisphere. The Trump administration just declared a complete closure of Venezuelan airspace.
Which is effectively establishing a no-fly zone and a naval blockade.
Right, and it's all ostensibly under the pretext of counter-narcotics.
Look, this is a pre-war level of pressure, full stop. When a major power declares a sovereign nation's airspace closed in its entirety, that is a direct challenge to international law and the sovereignty of that state.
And the pretense is getting, well, it's getting demonstrably thinner by the day. The U.S. has already been running Operation Southern Spear in the Caribbean.
We've seen casualties there.
Over 95 deaths confirmed in boat strikes. But the deep analysis shows they've completely shifted focus. While they claim to be targeting white powder cocaine, the operational reality is that the maneuver is designed to throttle the flow of black liquid.
Venezuela's oil, its primary economic driver.
Exactly.
That strategic pivot is key. This isn't just about drugs. It's a structural energy blockade in the Western Hemisphere, and it reflects the U.S.'s deepening anxiety over sanctions fatigue.
And the axis of resistance expanding its reach.
Exactly, expanding into South America. And when you look at the reaction from Brazil's President Lula, who directly likened this to the 1982 Falklands conflict, you see immediately this is escalating beyond ideology.
It's being framed as a sovereignty issue.
It's now being framed as a defense of regional sovereignty against outside military intervention.
And this tactic of maximizing pressure via pretext, it mirrors exactly what we're seeing simultaneously in Eastern Europe.
Let's talk about Ukraine.
Right. So we saw the high-profile leak of the 28-point peace plan, a plan demanding NATO abandonment, recognition of Russian sovereignty over Crimea and Donbass.
At the exact same moment.
At the exact same moment, Russia confirms a new offensive in the northern border areas, Sumy and Kharkiv.
This is a textbook hybrid operation. It uses information and military action in tandem. The attack on small, strategically minor settlements like Krybovsky, it's not designed primarily to seize territory.
Which is what we usually focus on.
Right. It's designed to create overwhelming psychological pressure and maximize despair, forcing Kyiv to divert critical defensive forces away from the main Eastern Front.
So it's a calculated military action aimed primarily at the cognitive space.
Absolutely. This demonstrates the paradox of endgame violence. As peace negotiations gain traction, the physical violence paradoxically escalates.
Because both sides want to establish facts on the ground.
They're trying to establish the most favorable facts on the ground before any final agreement is drawn. And if we read the strategic implications, it explains why German leadership has repeatedly warned of a potential NATO conflict by 2029.
They don't see this as a path to lasting peace.
They view any current truce as merely a guaranteed Russian rearmament and repositioning period.
Okay, let's pivot sharply now from kinetic friction to structural financial shifts, starting with a massive move in Japan.
A huge move.
The Bank of Japan just hiked its policy rate to 0.75%. That is the highest level we've seen in 3 decades, since 1995.
For a world built on cheap money, this just fundamentally changes the assumption of global liquidity.
It ends what many leveraged players called the free lunch.
It does. For 20 years, the yen carry trade allowed hedge funds to borrow yen at near zero and invest globally in high-yielding assets. It was a massive, invisible source of liquidity.
And raising the cost forces a mass recalculation.
A recalculation of leveraged positions worldwide.
But here's where the data becomes paradoxical and really requires a deep dive. While 0.75% sounds high for Japan, their core CPI is running at, what, 2.4 to 3.0%.
Right, which means if you calculate the real interest rate, it's still deeply negative, sitting near -2%.
So this is still extreme monetary easing by any global standard.
Which raises a critical question. If the real rate is still so negative and the carry trade is more expensive, how did the global financial system avoid a massive, immediate crash?
The answer is outside Japan.
Exactly. The markets prioritized the resilience of the U.S. dollar, which was buoyed by the fact that U.S. Q3 GDP was reported as a very strong 4.3%.
That strength allowed a risk-on mentality to continue.
It did. It allowed the market to absorb the shock of the narrowing rate gap in Japan.
That structural shift in Asia leads us directly to the profound structural cracks we are seeing in the world's second-largest economy, China.
A China paradox.
An extreme divergence in their data. On one hand, LVMH sales just rebounded, showing growth of 1% in Asia ex-Japan.
But on the other,
the percentage of manufacturing zombie firms, those that can't cover debt payments from income, is hitting a record high, and the Consumer Confidence Index just continues its steep decline.
this is the textbook definition of a K-shaped recovery. The top tier thrives while the masses struggle.
And the LVMH recovery isn't broad.
No, it's driven by quiet luxury and ultra-high net worth individuals, the VICs, very important clients. They are not signaling an economic recovery. They're signaling asset protection.
So they're hedging.
Wealthy individuals are desperately buying high-value global brands as a hedge against potential RMB devaluation and the collapse of the domestic real estate myth, especially with developers like Vanco facing crises.
So these luxury goods, a handbag or a watch, are functionally acting as a kind of portable, safe haven asset.
Exactly. They are buying global value outside of collapsing domestic asset classes. And the structural problem holding the Chinese economy back is Japanization.
Propping up inefficient firms.
The government is so fearful of massive job losses that it props them up, which fatally stalls economic metabolism. The long-term consequence is the transformation of China from a mass volume market into a high-end niche market.
This fragmentation leads us directly back to the confusing signals from the U.S. consumer. We have robust hard data. U.S. Q3 GDP growth at 4.3%, significantly beating expectations.
But then you contrast that with the soft data.
The Consumer Confidence Index has declined for 5 straight months, dropping to 89.1.
And that strong GDP is not a reflection of the average household's financial health. It's driven by 2 factors: massive government outlays, the GPS Act, defense spending, and by asset-rich, wealthy consumers.
Meanwhile, the consumer fear, the vibe session, is rooted in real pain.
Cumulative inflation, cripplingly high credit card debt, and rapidly falling spending on large durables, things like furniture and appliances.
So what's the strategic read-through here for Federal Reserve policy?
Well, the paradox is that the strong GDP reading justifies the Fed maintaining higher for longer rates, which in turn pressures the average indebted household via higher mortgage and credit card costs.
So the pain is structural and self-reinforcing.
It is. And the major long-term risk here isn't today, it's the promised 2026 tariff shock from the incoming administration.
Why is that so dangerous?
Because that policy would cause both simultaneous price increases from tariffs and consumption cuts from uncertainty, almost guaranteeing a Fed policy error.
Moving back to geopolitics, we have a very ugly escalation in the South China Sea. Near Sabina Shoal, the Chinese Coast Guard targeted Philippine civilian fishing vessels,
Using high-pressure water cannons.
injuring 3 crew members and damaging 2 boats. This is a significant shift.
It absolutely is. This moves the gray zone tactics beyond harassing government ships to directly targeting civilian life and livelihood.
And the calculation here is strategic.
Very. These non-lethal weapons water cannons, ramming, are specifically chosen because they skirt the threshold of the U.S.-Philippine Mutual Defense Treaty Article V trigger.
Which requires an armed attack.
Which requires an armed attack. This is the definitive salami slicing. They take a little more sovereignty without ever crossing that red line.
And targeting civilians is a cognitive strategy.
It's a calculated cognitive warfare strategy. The goal is to terrify local populations, forcing them to self-censor and stay off the water. If the civilian presence is eliminated, The Philippines essentially loses the presence required for effective jurisdiction.
Conceding control without a shot fired?
Precisely.
That physical fracturing is mirrored in the technological domain, where the lines are even blurrier. The U.S. just revealed a systemic cyber threat.
The F5 breach.
A nation-state actor linked to China had long-term access since 2024 to F5 Inc.'s network, stealing the source code for their critical BIG IP products.
You cannot overstate the severity of this. F5's big IT products are, for lack of a better term, the Internet's intersection. They manage traffic and security for nearly every Fortune 500 company and major government.
And the source code theft is catastrophic.
Because the attacker can now map out zero-day vulnerabilities and potentially pre-position backdoors into the world's most critical network infrastructure. This is what we call operational preparation of the environment, or OPE.
Setting tripwires for a future conflict.
The setting tripwires, installing permanent access so they can flip the switch when a conflict begins. This is far beyond industrial espionage.
It's a single point of failure waiting to be exploited.
And it accelerates IT decoupling. Western allies are now forced to immediately tighten supply chain assessments. Trust in the core infrastructure is fundamentally broken.
Finally, let's look at a growing choke point in Africa, Sudan. The RSF paramilitary force just captured the crucial Heglig oil field.
This is immediately critical. Heglig is where South Sudan connects to the only operational pipeline to the Red Sea.
So its capture chokes off their entire economy.
It chokes off 100% of South Sudan's oil export revenue. You now have a high risk of two nations collapsing simultaneously from one internal conflict.
And how does that internal instability link to the global picture?
It transforms Sudan's civil war into a full-blown regional crisis. South Sudan now has every reason to conduct a military intervention to secure its only economic lifeline. This links the failure state built from the Sahel directly to the Red Sea, exacerbating global instability.
Let's return to where we started. The gold and Bitcoin divergence, $4,400 gold spike versus Bitcoin sitting down 6% year to date. We've talked about polyfracture everywhere. What is the definitive structural takeaway about this new asset order?
The great irony is that the institutionalization of Bitcoin, the ETF approval, while successful in bringing capital in, simultaneously destroyed its function as a true crisis safe haven. It linked it too tightly to the volatile tech sector.
While central banks go in the other direction.
Meanwhile, global central banks, notably China and Russia, are buying gold massively. Not for a speculative trade, but for de-dollarization and as the tangible, physical asset of last resort. This reflects a fundamental structural distrust in digital systems and fiat currency in a fracturing world. The physical bar is winning the crisis test.
A truly sobering thought. Building on the paradoxes we've discussed, where short-term security measures create long-term quagmires, consider the risk inherent in any conflict that uses physical presence to impose immediate security. The act of attempting short-term security through physical presence often risks creating an inescapable, resource-consuming quagmire that permanently closes the door on a viable political solution, thereby guaranteeing decades of future conflict simply to maintain that security presence.
Neural pulse. Clarity in a complex world. See you tomorrow.